Luca Pacioli was a wandering Franciscan monk and mathematician. He was a contemporary of Columbus and a friend and collaborator of Leonardo da Vinci's. His Summa di Arithmetica was published in 1494. It contained a section that described the bookkeeping system used in Venice. This was just 4 decades after Gutenberg's invention of movable type. Printing centers all over Europe soon allowed Pacioli's Summa to be translated and printed, and his ideas soon spread across the continent. You could say that the printing press was the equivalent in his time of the internet today. It was kind of at the bleeding edge of technology.
Professional accounting bodies and our education industry would have us believe that accounting is exceedingly complex. This was, of course, true in the Middle Ages, when only 10% of European men could read or write. The rudimentary algebra that underlies the balance sheet equation was about as well understood then as nuclear physics is today. Today, most high school students learn the basics of algebra in grade 9 or 10. With that basic knowledge, accounting fundamentals are beautifully and elegantly simple.
While the first bookkeepers meticulously recorded each transaction in journals or books of account, today we mostly harvest transactions from our online bank or credit card accounts. In this course, we will use readily available online information and AI tools to help us understand rudimentary accounting theory and generally accepted accounting principles. Then we will apply what we learn on the job by summarizing transaction data harvested by small businesses so that it's ready to post to a working trial balance. In this series of 2 presentations, we'll review these fundamentals in about 30 minutes. First, we'll look at the who, what, when, where, and why of accounting. In the second, we'll briefly explain the how. Afterward, you won't be a professional accountant or competent bookkeeper, but you should have a better understanding of accounting fundamentals. So who uses accounting information? Owners and owner-managers of businesses need to know if they are making money. They need to know who owes them money, how much tax they have to pay, and which suppliers they owe money to. Tax authorities rely on businesses to pay their taxes to pay for shared government services. Lenders need financial information to know how reliable prospective borrowers are. Investors need financial information. Otherwise, they're just gambling. Accountants record and compile transactions. So what the heck are transactions? When you sell stuff to customers, you're engaging in a transaction, but so is your customer. The customer and the seller or supplier are both entities engaging in the same transaction. Most transactions involve 2 or more different entities. More about entities a little later. But let's get back to transactions first. Traditionally, buyers exchange cash for stuff, while sellers sell stuff for cash. The amount of cash is the agreed price for the stuff, and accountants for both parties record both the cash and the stuff, denominated at the agreed price. The buyer reduces his cash and increases his stuff. The seller increases their cash and reduces their stuff. Looked at another way, the seller records the mirror image of the buyer's transaction. Transactions between buyers and sellers typically involve representatives from 2 distinct businesses. In other words, from 2 different business entities. Businesses employ or contract with accountants to record and compile financial transactions from their own perspective. So what is an entity? For an introductory course in accounting, we'll restrict the discussion to the 3 most common forms of business entity. First, proprietorships owned by single individual persons. Second, corporations which are separate legal persons are distinct from their owners or shareholders. And third, partnerships, which compute their incomes as though the partnership is a separate person. While from an accountant's perspective, the accounting for each type of entity is quite similar, the legal liability of proprietors, partners, and corporate shareholders is quite different. If we have different types of business entity, that presupposes that we understand the meaning of a business. So what is a business? In Canada, business isn't just a casual word. It has specific legal meanings depending on the context: tax, corporate law, or regulatory frameworks. The Income Tax Act and the Canada Revenue Agency, CRA, define a business as an activity that you intend to carry on for profit, and there is evidence to support that intention. This includes a profession, a calling, a trade, a manufacture, an undertaking of any kind, an adventure or concern in the nature of trade. Note that when accountants record transactions, it is done on the assumption that there is a business carried on for profit by a separate business entity. Westerners like myself tend to have a Eurocentric view of history. However, it seems that variants of double-entry bookkeeping were used much earlier in India, Egypt, and Korea, before Luca Pacioli published Summa di Arithmetica in 1494. In this presentation, we looked at the who, what, when, where, and why of accounting. We discussed what transactions are and the common types of business entities that engage in them. In Part 2, we'll look at how accounting is done. Thanks for watching.